Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's Tuesday morning, getting into the week. Yesterday, of course, was a down day, second down day after Friday's little bit of profit booking. What does today hold? That's a big question. I'm Prashant. With me, my colleagues Nigel and Reema. And I think, Reema, green is an indication?
Yes.
Green, we've got 2 days of pullback. Normal after a 1,000-point rally. But let's see today. S&P, Nasdaq, Dow continue to power on. Fresh highs.
That's right. I'll go with Reema. The color of the day for Navratri is red. So I think we should, maybe it should be a green day.
Well, let's hope so, because last night U.S. markets have hit another record high. I mean, you know, U.S. and India both have been they were kind of sort of step in step, right? Lock in step till at least the year before last, and divergent paths since 2024. Let's take it from the top. So U.S. indices hit fresh record highs once again. I think it should be the 30th, at least close to the 30th record high, fresh high in 2025 so far. S&P up 0.4%, Nasdaq 0.7%. And it's all about tech stocks, right? I mean, it's fueled by one name after another. And I'm being forced to, I don't usually talk about individual names and what they did, but it's consequential. NVIDIA, 4%, after it said it would invest about $100 billion in OpenAI to fund an enormous data center build out. That is NVIDIA for you. Apple, 4%, and analysts essentially saying that the iPhone 17 upgrade cycle is being underestimated by the street. I'm an iPhone, I don't want to reveal, but, a couple of steps behind iPhone 17. Oracle was up 6%, and this after White House. There was a Bloomberg report, and Bloomberg said that White House has confirmed to them that Oracle essentially will secure TikTok's US algorithm to facilitate a sale to American investors. Oracle is part of that group, apparently, and Oracle was up 6%. So you got NVIDIA, Apple, Oracle, at least the large tech companies, tech stocks, which did very, very well. So it's really large cap, mega cap, technology led. Lots of Fed commentary on interest rates. Most of it, and I'm not going to go into the detail, I'm just going to put out the outlier. Most of it was cautious. So some 4 or 5 Fed governors, some voting members and others, not all spoke. And most were cautious in terms of whether this is the beginning of an easing cycle, except one. And I think that one, I sort of hinted at that yesterday as well. This is, of course, President Trump's confidant, Fed Stephen Miran, who's, of course, come on the board of governors now. He said that interest rates should be much lower to prevent damaging the economy. It should be closer to the mid 2% area, and a neutral rate of interest rates has been pushed much lower. So, this was expected. But he was also perhaps the only one during that last week's FOMC meeting who voted for a 50 basis point cut. Others were all at 25. This is just last week, a few days ago. Tonight, that is, focus will be on the September PMI numbers and, of course, Fed Chair Powell's speech. So we'll hear from him again. I'm not sure whether we will hear something new. Just to tie in the levels and, close that out, Nifty yesterday closed below the 40-hourly exponential moving average in the final hour of trade. Remember, yesterday the market sold off, recovered fully, almost into the green, and then there was that second wave of selling. But we didn't stay at the lows. The market did rebound about 70, 80 points. So support is 25,151, which is yesterday's low, and then 25,133. So those are two immediate support levels. Resistance is the high of 25,449, and then the upper end of the rising channel, which is 25,620. And the Nifty Bank yesterday closed marginally below the 40-hourly exponential average, like the Nifty. And here the supports are 55,215 and 55,027. So that's the roundup as far as levels are concerned. GIFT Nifty indicating a 20-odd point lower kind of a start. Yesterday, of course, the broader market was under a little bit of pain. I mean, market breadth, etc., was negative. We'll pick up on some of these things as trades opens up today. But how are the F&O stats looking? Nigel has walked across he's got those for us. Nigel, good morning.
Well, as you mentioned, Prashant, overnight, global Q is stable. You like that. And also, today is going to be a big day because it's Tuesday, and that's why you'll have the Nifty weekly expiry that will play out. Now, in yesterday's trade, the overall volumes are relatively lower in terms of institutional participation. The FIs, though, they sold while the DIs bought. However, after a while, you had the institutions put that together. There was a net sell number coming in from the institutions on the whole. And that's why we did see some kind of profit taking on the index. But in the F&O market, well, there was some unwinding, some lightening of position. And this is for the second day running that we're seeing that, both on the Nifty and to a larger extent on the Nifty Bank. And that perfectly ties in with what the FIs did in the F&O market itself. So they did unwind, they did cover some kind of short positioning. If you look at index futures, they covered close to around 1,900 short contracts or thereabouts. The short positioning, though, continues to remain aggressive at around 87%. In absolute terms, it's more than 1.4 lakh contracts on the short side. So the FIs, yes, they've lightened positions a little bit, but they're still net short. Moving to stock futures, well, out there as well, they added more shorts than longs in the ratio of close to around 2 shorts for every 1 long position. And now they're writing calls aggressively as well. And that's precisely what we saw in yesterday's trading session. More than 8 calls were written for every 1 put. And because of this aggressive call writing, you have the PCR that's come down. A few sessions ago, it went dancing away to around 1.35. Because of the aggressive call writing, now it's come down to around 0.72. Remember, we have seen when this PCR moves around 0.65 or thereabouts, that's when you see a bit of a bounce. So we're closer to the lower end of the range. And the calls that were written comes up for you on the screen. 25,300 call, 25,200 call. Between that, 2 crore shares getting added, and these expire today. So aggressive call writing is what we have seen in yesterday's trade. I'll tell you what, if the markets can get their momentum, these guys will be in trouble. So they are playing on eating into this premium just for today. So we'll have to keep an eye on that. On the put side, 25,200 put, though, saw a fair bit of open interest build up in trade yesterday. So levels. Yesterday's low, well, that becomes the near-term support. 20, 30 points lower as well. You don't want this level to break decisively. And on the upside, yesterday we went to 25,331 and we saw a bit of a resistance out there. But that's the mark you're looking at. On the Nifty Bank, which is the last constituent, it sold off in the last hour of trade actually. But otherwise, it was holding steady. You want to see a higher high. The last few days, it's been making lower highs. So that's the mark. Today, you'll want that level to get taken out. And the tech index got hit yesterday, but Nasdaq was quite stable overnight. Sometimes there is that correlation that plays out. Let's see whether or not we can see a bounce after the kind of selling that we saw yesterday. And finally, in terms of stocks that I'm looking at, we alert you on closing bell about potential stocks that are moving in and out of the F&O ban. RBL, well, that's the one that's come into the F&O ban. The big positioning being added out there. So I'll keep an eye out on that stock. The shorts are getting a little bit nervous on that one. While Angel One is the one after a few trading sessions that's come out of the F&O ban. We're alerted to you about both these two in yesterday's trade itself.
Nigel, why I'm going to go with green? I was just thinking, because this festive cheer is showing up in the auto sales numbers.
Yes, indeed.
Right? Hyundai delivered 11,000 sales yesterday, its best single-day performance in 5 years. Maruti did even better. 30,000 sales delivered yesterday and very large inquiries. Sudarshan will talk more about it. And also today is going to be a busy day on the IPO front. 4 IPOs open out for subscription. We'll get chatting with one of them, Anand Rathi, on the show later on Bazaar. But let's also get you the equity calls for the day. Sanjeev Prasad of Kotak Institutional Equities expects stabilizing earnings, strong growth in earnings in FY27 and a steady macro to provide a high floor to the market. But rich valuations across sectors and stocks and global headwinds will act as a low ceiling to the market. Therefore, markets may offer modest returns over the next 12 to 15 months, with growth in earnings being partly offset by lower multiples. All right, let's move on then and get a handle on the global cues and the impact on India. Mark Matthews of Bank Julius Baer & Co. is now with us on the show. Mark, first, weigh in on what's happening in the US market. Is there way too much exuberance that's being priced in? Look at the S&P 500, 17% up so far year to date. Last year it was up 24%. The year before that it was up close to about 23%. And while AI is propping up, even in this NVIDIA OpenAI deal, we're talking about $100 billion of an investment. Of that, the cash component is only going to be $10 billion. The rest of it is going to be about future sales coming in from OpenAI as they buy NVIDIA chips. So, is there just too much excitement?
It's hard to quantify this. You may recall in 1995, Alan Greenspan warned about irrational exuberance. I might have got the year wrong. It was around then. And of course, we had the dot-com bull market literally after he said it, that lasted up until 2000. So there is exuberance. There are signs of a bubble. You mentioned OpenAI. The CEO, Sam Altman, said last month he sees kind of bubble-like market. But just to use NVIDIA as an example, because you also mentioned that, and it is the bellwether for this technology-led bull market today, NVIDIA trades at somewhere, I think, around the low 30s next year's earnings. So it's sort of in between 32 to 35 times next year's earnings. And that is very expensive, of course, relative to the long-term price-earnings ratio of the S&P 500, which is around 15 times. But is it a bubble? I don't think so. I think a bubble is something you start talking about above 40, maybe even above 50 times PE. So exuberance, yes, but this is something that I think can continue to persist if we look at past bull markets like this, most notably the dot-com bubble, where the top 5 technology stocks peaked at something like 55 times their next year's earnings in the year 2000.
Yeah. So NVIDIA, low 30s P multiple, right, Mark, you're saying? Morning.
Yes, 12-month forward PE is probably around 33
and growth
times.
at what, 25% odd?
NVIDIA's growth, I don't know the latest numbers. I suspect it's in the high 20s. Yeah, for the Mag 7, the growth in the most recent quarter was in the mid 20s. It is going to come down into the teens over the next 12 months.
You know, don't you think, Mark, more than P multiples, right, as a metric, perhaps it is this massive spending which is underway, which, and if there is any slowdown from some of these hyperscalers, etc., because of a variety of reasons. I mean, for example, on ChatGPT 5, there have been lots of, some criticism that it's not up to what it was built to be. There has been, there have been research papers showing that incremental benefits are not what is expected for all the spending which is going on. So return on investment is the big one, which has always been the case. You think that at the margin is the risk? Because, I mean, here in India, 30p multiple is very very reasonable. 50 is doable. And only when you get to 70, 80, 100, and there are many here, you get into the euphoric, exuberant kind of band. So just wanted your thoughts there, Mark.
Well, the first time that this was highlighted, the idea that they're spending more than they will recoup was in June last year when Goldman Sachs published a report stating exactly that the spend on AI will not be met with an adequate return. And of course, the market has gone up a lot since then. So it had a wobble last summer on that idea. But the earnings growth of the Mag 7 has been so good that the market is willing to give them the benefit of the doubt. And I don't know the answer, honestly, whether this it will be kind of like Amazon, say, 15, 20 years ago, was trading on much, much higher valuations, but it grew into those through the exponential growth of its e-commerce and its cloud business. Will it be like that, or will it be a big disappointment? I don't know. I think only time will tell. But I think what we are seeing is already the benefits of AI flowing into the broader corporate sector in a rise in revenue per worker. And it's been happening for a couple of years now. I suspect it is related to AI to some degree. And you saw similar rises in revenues per worker with the introduction of PCs in the 80s and the internet in the 90s, cloud computing in the 2000s. So I think it is going to be very good for productivity in corporate America. But at what price do you pay for that? That's the big question. I would just say that, as I mentioned earlier, around 30 times is still not a price that you would consider absurd.
Hi, Mark. Good to see you. Well, the U.S. markets have been running on steroids, actually. Nothing to stop it. But there are some near-term risks. And last week, the Senate rejected the Republican as well as the Democratic proposals to at least temporarily fund the federal government. Can lawmakers strike a deal prior to September 30th, or are we bracing for a bit of a shutdown? History suggests that normally they get past it. But do you think that could be a near-term risk?
I don't think so, really, because if you look back at other government shutdowns, I don't remember the last time they had one. It was around 12 or 13 years ago. You have some small disruption, but eventually, they agree to extension of the debt ceiling and things come back online. I suppose the only risk people are thinking about this time is if a shutdown prevents the federal government bodies that do release data from releasing that data in a timely manner, like the labor market data and the inflation data, then the Federal Reserve wouldn't be able to make decisions because it doesn't have the data. So that's something I've read that is a concern, but I suspect it won't end up being anything material.
Very quickly, before we let you go, the dot plot suggests that maybe, in fact, we get 2 more rate cuts this year. Do you think we do?
Yes, we are penciling in 2. And I think the Fed wants to get ahead of the curve. They've clearly indicated the priority is the labor market rather than inflation. And in the labor market, you have very little firing, but you also have very little hiring. So if, for whatever reason, the firing was to go up, the unemployment rate would rise quickly, and they don't want to have that happen.
Okay, Mark, thank you very much for joining in on the shutdown bid. We've had so many scares in the past, right? But last minute, there's always been a bipartisan deal which has been stitched together, and that government shutdown has been avoided. Mark, great chatting with you this morning. Thank you once again. Let's tell our viewers the interactions that we've lined up on the show today. So first up, coming up at 8:35, don't miss the CNBC TV18 big exclusive. The chairman and CEO of JP Morgan, Jamie Dimon, on India-US ties and the US economy. At 9 a.m., we will be joined by Ajit Kumar of JM Financial for a discussion on the banking sector, the stocks which look good. At 9:20, we go back to the JP Morgan conference and invite Rajiv Batra. He will be our market master for the day. 9:35, on our corporate corner, Neeraj Akhoury, the MD of Shree Cement, will join in to talk about the impact of the GST cuts on their business and if there has been a sales pickup. And following that, we will be chatting with Pradeep Gupta, Chairman Managing Director, Anand Rathi Share and Stock Brokers, whose 750 crore IPO opens today. And towards the end of the show, in our special segment, It's the Economy, Lata will get chatting with economists Jahangir Aziz and Luis Organis of JP Morgan on global and Asian economies, currencies and commodities. All things macro.
Time to slip in a quick break. Got a lot of stock-specific action, a special top 10 segment. For the time being, I give you a sneak peek into the list. Maruti, Hyundai, Defense Stocks, KC International, Brigade Enterprises, RVNL, Birla Corp, JK Lakshmi Cement, Shilpa Medicare, as well as JBM Auto. It could be that sort of a day. Most of these should react in the green. None of them in our top 10 segment will react to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. Yesterday, markets gave up close to about 0.5%. Over the last 2 days, we've corrected about 250 points on the Nifty. But this comes on the back of a near 1,000-point rally. As we speak, the Nifty is at 25,200. And the GIFT Nifty is suggesting a flattish start. The picture across Asia is a bit mixed. On the way up, you've got the Taiwanese, Korean markets surging, perhaps given the AI optimism, and the entire ecosystem is doing well. And many of these stocks are up and about. But Hang Seng is a bit under pressure, but there is a typhoon there, which is also hurting business. But let's get to the individual stocks then. This is our CNBC TV18's list of top stocks for the day. Our entire research team is standing by. And first up, it's about autos and the record sales done by Maruti and Hyundai yesterday. A very auspicious start to the Navratri season for them.
So the comments from these auto companies reminds me of a dialogue from a movie, Uri Surgical Strike. How is the Josh? It's high, sir, and that's what reflecting from the comments from Maruti. It's saying that the inquiries are coming. It's like it has never seen in the last 35 years, and it remains very high. And there is a probability that it might even run out of inventory in some of the variants. So on the first day of Navratri, it has recorded 80,000 inquiries and has delivered more than 25,000 cars, and saying that very soon it's likely to deliver even 30,000 cars. And since at 18th of September, the day it had announced the additional discounts and the pass on of GST cut, it's been seeing 75,000 bookings. And on a daily basis, the bookings have been 15,000. That's almost 50% higher than the on the normal days that company has been seeing. And the most positive part is the response that company has been getting for the entry-level segment, where the booking has been growing by 50%. So the comment from Maruti will also be positive for in the bike segment. The companies like Hero Moto, TVS, and Bajaj Auto, if Maruti is getting a huge response for entry-level segment. Hyundai has also said that on day one it has recorded around 11,000 dealer bookings, and it's the highest single-day performance that company has seen in the last 5 years, and believes that this kind of performance may continue even going forward in the festive season.
All right, sir. Thanks a lot for that. I'll keep an eye on you when we leave in the evening from the parking lot. Sud in new wheels. Josh may be high, Sud. Always on your case. All right, let's hop across to Ria. She's standing by to tell us about the defense-related names. Morning, Ria.
Well, good morning, Nigel. A lot of important commentary coming in from the Defence Secretary yesterday. In terms of capex, he has said that in value terms, we are expecting rupees 25 to 30 billion at a minimum per year in capex terms for defence. And the current plan is to spend around 75% of this capex within India as a part of indigenization efforts. On the budget, he has said that last year, for the first time, we exhausted our defence budgets, and this year the plan is to repeat the same. And in fact, this year we've already hit around 3/4 of contracts of last year, and this year we're going to cross around 2 lakh crores. He has also said that he is confident that the Finance Ministry will be able to provide a 10% increase over the current budget, and in the medium term they are going to ask for at least 17 to 18% of an increment every year. Lastly, in terms of the current capability and the roadmap ahead, we are planning to release the RFP for the Made in India drones quite soon. The total value for this will be around rupees 30,000 crores, and in fact the Air Force has also pointed out certain capability gaps, and going forward the Defence Secretary has highlighted that we are going to look at some capability multipliers like refuel aircraft and as well as airborne warning and control systems. So on the back of this, the entire defence pack is expected to be in focus today.
All right, Ria, thank you very much for that. So it's an important story, and by the way, we're going to play out sound bites so that the chat with the Defence Secretary in a bit from now as well. More stocks with news flow. Vamakshi has got those. She's joining us. Vamakshi, morning.
Good morning. Let me first start off with KEC. Several order wins for the company. They've won orders worth almost 3,240 odd crores, and this is largely in the international T&D business of theirs. And within those orders, they've managed to secure the largest ever EPC order till date. Now, given these orders, year to date, the order book has now increased to 11,700 crores for the company. Bodes well for KEC, going with the green for this counter. Brigade Enterprises is the next counter that we're watching out for. They've signed a JDA agreement, which is essentially a joint development agreement to develop a residential project in South Bengaluru. Now, this project is expected to have a gross development value of around 1,200 crores. Again, bodes well for this counter, green for Brigade Enterprises. And lastly, green for RVNL as well. And that is because the company has emerged as an L1, that is the lowest bidder for a project from Southern Railway. And this project is worth 145 crores.
Okay, all right. Thanks a lot for that, Vama. Well, let's focus on a couple of cement names. Some mild positives is what we did get overnight. So Birla Corp first up, they've been declared the preferred bidder for Gudda Rampur limestone and manganese block in Telangana. The premium that's locked is at around 57%. Do note that the company doesn't have any kind of cement unit in this particular region, which is Telangana. But why is it good? It secures raw material supply, and it's positive. In case they plan on setting up a unit over there, then for the longer term expansion plan, it bodes well. So going with a tinge of green on Birla. Moving to JK Lakshmi Cement, they've commissioned a 1.35 million ton grinding unit at Surat. They've also completed the debottlenecking at Sirohi, and that's what they had promised earlier as well. Now, with this commissioning as well as debottlenecking, they moved from around 16.5 million tons of capacity to around 18 million tons of capacity. And as they've been saying for the last many quarters, the target is ultimately to move to around 30 million tons. So going with green on this one. But let's go to Vinny. Vinny in pink today. She's here to tell us about Shilpa Medicare as well as JBM Auto. Morning, Vinny.
Hi, Nigel. Good morning. So, yes, keeping an eye on both these names. Now, Shilpa Medicare, positive news flow after they've received initial authorization from European Medicine Agency. This is for the drug Rivaro Zacpan, which is in the European market. The market size of this drug is around $2.5 billion. This is mainly used for preventing blood clots. So, positive drug approval coming in here, a big market size for Shilpa Medicare, and that is why green is what we could see. JBM Auto, this one also we are expecting green here after JB Electric Vehicles and Al Habtoor Motors have forged a strategic partnership to provide e-buses and e-electric vehicles in UAE. Now, obviously, Al Habtoor Motors will be an exclusive importer and distributor for JBM Electric's buses in UAE. So, positive there as well.
Thank you very much for that. Zensar Tech has also clarified to the exchanges about the potential impact on account of the H-1B visa. No numbers shared about how many visas they've sponsored, but they do say we do not foresee any significant impact on the financials or operations given our lower dependency on H-1B visa. Let's see whether IT can bounce back after yesterday's cut. Here's a quick recap then of the top stocks. Stocks with positive news flow are Maruti, Suzuki, Hyundai Motors, and watch whether it rubs off on the rest of the auto pack, even though they haven't declared what the sales numbers look like for yesterday. Defense names should be on your radar. KEC International, Brigade Enterprises, RVNL, Birla Corp, JK Lakshmi Cement, Shilpa Medicare, JBM Auto. No stock, at least on our radar as of now, is likely to open in the red. All right, let's now talk about commodities and currencies. Manisha is now joining in for a complete roundup. Manisha. Oops, we've lost that line, but I think gold continues to scale new highs yet again.
Yes.
Yeah, it's
Yes, new high
another
last
high.
night.
It's another high. And I think
$750 per ounce.
And silver continues to stay at
elevated levels.
At 14-year high. So we'll try and reconnect with Manisha to find out. Gold is, as you can see, at highs. But let's move on then and getting back to the big IT story that shook the markets over the weekend. Though we got the clarifications, IT stocks were under pressure yesterday. Industry body NASSCOM says that the impact of the H-1B visa fee hike has been softer than what was initially feared of the weekend. In what was their first response in the issue, NASSCOM President Rajesh Nambiar told CNBC-TV18 that Indian IT companies have reduced their dependence on H-1B visas by over 30% in the last few years. Listen in.
Over the years, I think most of the IT companies, IT services company, IT tech companies have reduced the dependency on H-1B over a period of time. So that which means that today we are looking at a much smaller issue compared to what we would have probably looked at maybe 4 years ago or 5 years ago. Good news is that this comes into effect only from the next year, which is 2026, new set of visas. So there's a little bit of a breather for companies to sort of enhance the skilling options that we have. From the last lottery, if you go back and look at from the Indian origin companies, because there are also companies which might have headquartered elsewhere, but clearly Indian origin in many ways. So those were the companies had roughly about 15,000 or so, which was issued in 2025. This was much lower compared to what it used to be. So we came down 30% over the last 5-6 years in terms of the number of H-1Bs, applied by these organizations.
Well, interesting comments there. Now, let's talk about the IT stocks yesterday, right? I mean, they all sold off 3-4% and didn't really recover by the end. There was some recovery, but not much. What did volumes, delivery stats, etc. look like? Hormuz is here with exactly that. Hormuz, over to you.
Good morning, Prashant. And yes, it was IT that dragged the indices lower yesterday as well, right? And it was the biggest single-day fall for the IT index since the month of April. From the tariff tantrum days is when this was the biggest fall for the IT index, almost 3% lower. The companies cumulatively lost close to 90,000 crore in market cap, more than half of which came from the fall seen in TCS and Infosys, which contributed to over 50,000 crore of that fall. Now, starting off with TCS, now if you take a look at the volumes yesterday, they were lower in comparison to Friday's volumes, and even on the 20-day average front, they were slightly higher compared to that. But if you take a look at the delivery volumes as well, even that volumes were lower than Friday's, and even then they were higher in comparison to the 20-day average for TCS, among the biggest contributors to the Nifty downside. Now for Infosys as well, in this case though, the difference being the fact that volumes on Infosys have been increasing significantly over the last 4 trading sessions. Now last week we had close to around 50 lakh shares on around last Wednesday, and come Monday, which was yesterday's trading session, we had almost triple of that volumes, which was close to 1.5 crore shares that changed hands in yesterday's trading session. The 20-day average here is only 80 lakh shares, and even on the delivery front, we had close to 1 crore shares that changed hands yesterday compared to another 90 lakh that changed hands last Friday, and the 20-day average here is just around about 50 lakh shares for Infosys. So fall on high volumes and an equally high number of shares marked for delivery as well. Among the top losers yesterday was Tech Mahindra. At one point, the stock was down almost 6%, although it recovered from the lows of the day. Take a look at Tech Mahindra's volumes. Even they were double in comparison to they were double in comparison to Friday, and more than triple in comparison to their 20-day average, almost 4x on that front. On the delivery front as well, close to 30 lakh shares marked for delivery, and the 20-day average here is only 9 lakh shares, so almost triple of the 20-day average on the delivery front as well for Tech Mahindra. You take a look at some of the other broader market names, be it Persistent, be it Coforge, all of them traded above their 20-day average. But the only standout here is Oracle Financial, the only IT name yesterday that ended in the green. Not significantly, but it did end in the green. But here the volumes are not only less than the 20-day average, but even on the delivery front, the volumes are significantly lower when it compares to the 20-day average for Oracle Financial. So IT stocks falling on significant volumes even on the delivery front as well, but the one that gained did not have as significantly high volumes as such.
Thank you. Harmas, even Info Edge closed up with a gain of about 3%. And I don't know if the market is making the correlation that if fewer of Indian techies go abroad on H-1B visas, if that is no longer the carrot which, perhaps they will look for jobs back home in India. And that could bode well for a Naukri business. But that's IT stocks and the delivery numbers and the volume numbers. Get into a break. On the other side, we'll get chatting with Amnish Agarwal of PL Capital for some fundamental stock talk. We'll also get you that exclusive conversation with the chairman and CEO of JP Morgan, Jamie Dimon.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Well, let's get in Amnish Agarwal, Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, the auto stocks, they are bracing for better times. However, the stocks have run up in the last 1 month or so since the time our Prime Minister indicated that there could be some rationalization on the GST rate. But the sales numbers are looking blockbuster just for the first day itself. Hyundai, Maruti, and that trend could continue as well. What's your view on the auto pack and what do you like?
Okay. You see, as far as your auto is concerned, I think it is a very big reset. For example, all the stuff which was at 28 coming down to 18, I think this reset is big. So, for example, tractors, they are down to just 5. And even for the bigger SUVs, or you can say the sedans above 4 meter, there has been a few percentage points reduction. This is a big positive. And the second thing is that from the last month and a half, the people were actually holding on to their purchases. Now, I would say for the immediate term, there will be, you can say, very, very strong uptick in demand. And usually what we have seen is that when such a big rationalization happens, the rub-off effect of that can actually last maybe even for the next 3 to 4 quarters. So I think the numbers will continue to be good and the auto stocks will continue to, you can say, look interesting. But having said that, there is some sort of, you can say, run-up which has already happened. So from the current level, one need to be very, very selective. Say, maybe you can say the PVs, they should do well. All the 3 front line led by, I think, M&M is, I think, one stock which has gained on all fronts. So M&M is one. Then even Maruti and Hyundai, these 2 stocks should gain. Among two-wheelers, I think TVS and Bajaj, they look interesting to us.
Look interesting means you can buy at these levels, because you also alluded to the fact that stocks have already run up. At this juncture, what can someone buy?
You see, the main thing is I would say that one needs to be very careful at the current juncture, because many of these stocks, they have risen by even 40-50% in the last couple of months, since August 15 in particular. So I would say slightly cautious at these levels. But having said that, on any declines, maybe I don't rule out, say, 5 to 10% correction in many of these stocks, and many of them have already seen some sort of a reaction. But on lower levels, all these frontline stocks, they continue to look good to us.
Okay, so buy frontline auto stocks 5 to 10% lower in the event of a correction. Yesterday, we got a correction in many of these IT names. Hexaware down 7, Zensar down 5.5, Emphasis, LTI, Mindtree, Coforge sunk by close to 4.5%. Persistence saw a gash of 4. Any of these stocks are buys for you?
You see, for example, if you look at, say, IT companies, whether it is, you can say, Persistent or, say, for example, Infy, some of these stocks, you can say we are having a positive view on them. But having said that, I think the yesterday's correction was more related to the reset which has happened, because for example, raising the H1B visa fees is something which is a new phenomena which has now come. And once it comes in, then there could be, say, more adjustments going forward. Will it be, you can say, a game changer that the growth rates are going to significantly go down? And that is, I would say, not the case. But having said that, it adds another bit of uncertainty to a sector where the growth itself was challenging. So to that extent, I would say at these levels, the dividend yields have become further attractive. But yes, how the entire scenario pans out, I think the sector is actually at the crossroads. But yes, whether you can say it is Persistent or some of these frontline, they now offer very good dividend yields and all. But definitely, any big run-up is not something which we are looking at.
Amish, 4 IPOs open today. One is Seshasai Technologies, 813 crore of an issue size. Anand Rathi, 745. Solar World Energy is looking to raise 490. And Jaro Institute, 450. So busy day. But have you analyzed any of these IPOs? And do you have a subscribe or avoid rating on any?
You see, I have not personally looked at any of these, because the IPO rush is so much that it has become really, really hard to catch up with the numbers in this.
Okay, we will slip into a break. Amnish, to stay on. On the other side, we'll get you that exclusive conversation with the Chairman and CEO of JP Morgan, Jamie Dimon.
Welcome back. You're with us here on Bazaar Morning Call. US should be India's best friend. That's the word coming in from JP Morgan's Chairman and CEO, Jamie Dimon, while speaking to me, with me, and sitting down with me for a chat, for a conversation on the sidelines of JP Morgan's annual India Investor Conference. Jamie Dimon said that he is optimistic of a resolution between India and US as far as the trade deal is concerned. We spoke about a range of issues. The H1B visa issue, he says, well, that caught everyone off guard, but it's another thing which he believes will be resolved in a favorable way. Listen in to a portion of that conversation.
The president and your prime minister clearly like each other, so which I think is good. I don't know what derailed it. I do think the Ukraine, Russian oil has been part of it, so I would take the president at his word on that. I'm still optimistic. In fact, I think Scott Bessent or the president recently said, no, we're going to get something done with India, and I hope we do. I think it'd be very important.
How will this work out? Because, I think the Indian side has been very clear. I'm not asking you exactly what happens, but there has to be an off-ramp, right, to knock those 25% off and then maybe work down the remaining 25% as well.
I'm not involved in negotiations. I don't know. Yeah. I do think they want to do something on the American side, and I think they want to do something on the Indian side. Yeah. And so I'm hoping that they resolve it intelligently. I think it'd be good for both parties.
Yeah.
And I think, India is a great friend of America. It should be. I know it's non-aligned, and it should stay non-aligned, but with their non-alignment, we should be their best friend.
And before coming in, I was watching CNBC, the squawk, and there was H1B, which was the big talking point headline. And it's kind of now sort of going into services as well, which so far it was not. It was mostly about goods. So is it expanding, or you think this is also all part of negotiation and it will finally settle down?
I think it'll finally settle down. That caught everyone off guard. And so we had a lot of phone calls over the weekend. What does it mean? And from what I understand, it means new H-1B visas. And a lot of H-1Bs go there because they need the expertise. And so I'm sure a lot of people will be going to the American government explaining why we believe it. I believe in merit-based immigration. As a matter of fact, I would beg the president, he has accomplished border control. That's great. I mean, I think all nations want real border control. That helps make a nation. But after that, we should have, good immigration. And I've heard him say publicly, more merit-based immigration, good seasonal worker stay, DACA stays. That if you get a degree in America, we should stamp a green card onto it. I agree with those kind of things, and so we'll hopefully be engaged in the government in this too.
The direction has changed in that sense. This administration coming in compared to where we were earlier, where we were going.
The administration is more growth, more pro-growth, but we haven't really attacked the fiscal deficit problem yet. Growth will do some of that. I don't know if they'll do all of it.
Okay. Yeah. Your call on the...
But the other thing about the deficits, and this is global, this is like every nation on the planet, and everyone's got very high debt levels too. I don't know when that becomes a problem. So, I can give you a logical argument that it can become a problem in 6 months. I can give you a logical argument it might be 6 years. But it will become a problem, and we're, like most problems, you're better off dealing with the problem than letting it happen.
Yeah.
And so I hope we are a little more thoughtful about that.
You weighed in strongly in support of the Fed when, we had officials from the executive making comments and sort of attacking the Fed, asking them to cut, etc. You think that's kind of sort of eased off a little bit, or how do you see this?
It'll start. I've always said that there's no American president who ever said, I want higher rates. So obviously they want short rates. President Trump has come out and said, I believe in an independent Fed.
Yeah.
He's quite strong about his opinions, but being independent is an important thing. The Fed is not really independent in other matters, supervisory, regulatory. I think there was too much of that, and they should have their ears cut back a little bit. But look, presumably, hopefully we'll pick a good Fed chair. Some of the names I think are quite good. I don't want to go through each one. And we'll see.
Weaker dollar, if I may so put it, is the strongest consensus right now. Do you agree?
I think there are, all things being equal, which they never are, you want a stronger dollar, because it generally means a stronger economy. But now, tariffs, trade, and all these other things that have some counterfact. And, there are people who are reducing their U.S. dollar investments, which I expect will continue over time. So it'll add to a little bit of the weakness of the dollar. And there are a lot of people in the United States who like the weaker dollar because it's good for trade. So we'll see.
Artificial intelligence, Mr. Dimon, is the other one, right? I mean, hundreds of billions of dollars being invested there. You think there is a risk of capital misallocation? I mean, it's a bit of a, I don't know if this is excessive, but...
So let me put it this way. AI itself is real.
Yep.
We have 2,000 people doing it, 500 use cases. I worry less about large models and small models and whether the costs will go up. I think the costs will be coming down. I think people are putting a lot of money behind it. So it is real, but in almost every real investment boom, you've had people who didn't do it right. So when cars boomed, a lot of car companies went bankrupt. When television boomed, a lot of television companies went bankrupt. When the internet bubble, that was real too. But I remember level 3 laid enough fiber optic. It took like 15 or 20 years to use it all.
Yep.
So parts of it may very well be in this kind of bubble thing, but parts aren't. So, but I separate that from the real, and we're going to be using it for a million different things. And so in my mind, it's more than using it. It'll develop over time. We're using large language models and small language models, open source models and closed models, and whatever works best for our company and our client is how we're going to do it.
The U.S. itself, you think it's a lot of economists were saying that, well, recession in the second half, it's not happened. I mean, high frequency data, hard data is still coming in very strong. Combined with, maybe the loosest financial conditions we've had in a while. Just wanted your thoughts about how you're looking at the U.S. right now.
There's a lot of conflicting, data itself is not perfect. There's a lot of conflicting data. But right now, unemployment is still low. consumers, both low end and higher end, are spending their money. At the low end, they're a little stretched, and credit losses are going up a little bit. So it's not a disaster; it's a weakening. I don't know if that's just a weakened economy or not. You have a lot of stimulus coming in the tax package, and you have a lot of I'm not going to call it stimulus, but spending on AI. So a lot of CapEx is up, but it's almost all AI, data center related. So, I hope it continues, and I'm a little more cautious on inflation than other people. That may not go away so quick because of the global deficits around the world. Those have an inflationary effect. The remilitarization of the world, the restructuring of trade, those things are all kind of inflationary, and maybe, less immigration in the United States, could help push up wages in the United States a little bit, which is not all bad because, a lot of people, deserve a wage increase.
Fifteen minutes to go before we open up for trade this Tuesday morning. It's also the Nifty weekly expiry, and for the last 2 days, markets have witnessed some profit booking. Let's invite our technical experts then on the show as we await the rates. Sudarshan Sukhani and Mitesh Thakkar are now joining in. Good morning, gentlemen. Sudarshan, let me start with you. 25,200 yesterday. What's your sense? How will today pan out? And what would the index call be?
Yeah, good morning. See, when the Nifty went below 25,200, then all long positions that I have been suggesting were stopped out. And that's okay because the long positions were taken at 24,700, 24,800, and so on. Even yesterday, if they were taken, there was a 100-point drawdown. That's acceptable. So currently, I don't have a suggestion on any positions because positions should be closed. Once a position is closed, the Nifty is now in some kind of a correction. It may bounce back today, may not. So today, my view is that the Nifty is best avoided.
Okay, avoid a Nifty trade today and let it play out. Mitesh, what would your call be?
Yeah. See, on the index, yesterday when we had a weak closing because we had a bounce back during the day, I suggested that we might actually dip a bit more and head towards 25, 150, 130 zones. I think that's an important support for me. 25, 150 was a hurdle when the market was trying to get up, get past those levels. So in that sense, I think, I'll be very okay with holding on to long positions and seeing how things progress from there. But that apart, I think, the overall directional bias for me remains on the long side. So my idea is that very clearly trade with long bias. And in case we don't see follow through selling post this decline from levels of 25, 150, then I think it will be even a good chance.
Gentlemen, morning. Great to have both of you here on the program. Mitesh, what would you do in terms of specific trades?
Yeah. So on the specific trades, Prashant, my idea is that we'll have a mix of buy and sells today because some stocks have kind of given breakdowns on the intraday charts with the recent market pullback. But broadly, the bias is on the long side. But today I have 2 buys and 2 sells. On the stock side, the first call which I have is a buy on Naukri or Info Edge. We had a very strong price and volume breakout taking place over there. So Naukri is a buy. I suggest keeping the stop just below levels of 1385. Look for targets in the range of 1465. The other stock which I like on the buying side, that's BEL. It had a very good move and come back to its gap support area after 3 days of a pullback. So good levels to initiate long positions. Buy here with a stop at about 402 and a target of 415, 417, 416 could be looked at on the upside. A sell on Bosch Limited. It's broken below its short-term averages, so slightly turning negative over here. There's a minor support pivot at about 39,400. So the idea is to sell if it breaks 39,400, keep a stop about 39,800. Look for a target of around 38,600. And the final call is a sell on Cipla, which I would recommend selling with a stop just above levels of 1560 for targets of around 1,500.
Got that. Thanks for that, Mitesh. Sudarshan, what about you?
Well, because I'm confused on the Nifty, the stocks also reflect that confusion. I have two intraday shorts. Havells is an intraday short with a stop above 1611. Astral is an intraday short with a stop above 1463, and two buying ideas. Chola Finance, buy with a stop under 1600, and Tata Steel, buy with a stop under 168. And then we also have weekly expiry today. So there's a sense of confusion.
Okay, gentlemen, we'll touch base with you in moments from now. In pre-opening, it looks like the Adani Group stocks will continue with the momentum. Remember, yesterday, the entire Adani Group stocks added more than 1 lakh crore in terms of market capitalization. And in a span of 2 days, after getting the clean sheet from SEBI, they added about 1.7 lakh crore. Yesterday, Adani Power, Adani Total, gas ended with gains of about 20%. And this morning, too, you are seeing some optimism. And auto stocks should be on your radar. In pre-open, Hyundai up 4.5%, Maruti's up 1.5%. But from our Reforms Reloaded event yesterday, Defence Secretary Rajesh Kumar Singh told Network 18 that the government will soon invite proposals for medium altitude, long endurance drone contracts worth 30,000 crore rupees. He said that the government is looking to double down on indigenization and will spend at least 75% of its defence capex within India.
If you're looking at it in value terms, I think you can expect in capex terms somewhere between 25 to 30 billion dollars minimum per year over the next decade, maybe a little more, I would say, rather than less. Our current plans are that at least 75% of our capex will be spent within the country. That's our normative target. Last year, we actually did 88% of our capex within the country. Last year, for the first time, we exhausted our budget. I think it is challenging to spend money in the Indian context, given the very elongated fail-safe type of procedures that we follow in terms of collegiate decision-making, approvals at the highest level, involving a lot of interministerial consultations. Last year we did it, and I'm sure this year also we'll do it. Really depends on how many contracts you end up signing. And last year we did a record number. This year we've already hit 3/4 of that, 1,50,000 crores worth of contracts we've already signed, or are in the process of signing if you include the LCA program. So we are confident we can do at least 2 lakh plus crores this year.
Okay, we should watch for defense stocks and drone makers. But for now, we've got our eye on banking names. Ajit Kumar, lead BFSI research analyst at JM Financial Institutional Securities, is now with us on the show. Ajit, morning. This is Rima here. So we know that the system-wide loan growth has been averaging about 10%. But can you give us a breakup of individual segments, housing loan, the vehicle loan growth, LAP, the MSME? What's been the loan growth, and how does this position the growth numbers that we'll get from banks and NBFCs in Q2?
Yeah, sure. So, good morning, everyone. Thanks for having me. So, yes, you highlighted it right. The biggest reason, in financials is for worry in financial is low credit growth of around 10% in India, YOY. If you, talk about the breakup of that, roughly 25 to 30% of that is going to be corporate loan growth. And private capex has not been picking up materially in last, let's say, 3 to 4 years. And corporates have delevered themselves, which is leading to low single-digit corporate loan growth in India. In corporate loan growth, loan growth is somewhere between, let's say, hardly, 4 to 5% on a YOY basis. In retail as well, which is another, let's say, 30% of the total pie, in last 2 to 3 years, personal loan, credit card loans were growing at 20 to 25%, which has now come down to, single-digit, growth due to the over-leveraging issue. While the RBI and our government has taken multiple steps, such as, front-loaded rate cut of 100 basis point, personal tax rate cut, recent GST cuts, we have not seen, much improvement in credit growth till now. As per the latest print, credit growth in India was, hardly, 10.3%. Even on GST cut, while it is going to be positive for auto companies, but from financing perspective, it seems to be negative as financing happens on all inclusive pricing, and hence there is a value decline which is going to happen. So net, our belief is credit growth is going to inch up due to this multiple step. But having said that, max to max, it will go to, let's say, 11 to 12% by FY26, not more than, 12%, when we end the year, in March 26.
So you're saying even though we're getting bumper sales numbers and we might get, good buoyancy, for vehicle financiers it will be negative. Is that priced into the stocks, or is there scope for downgrades?
No, our sense is for vehicle financiers, I mean, their valuation is, way too high as compared to their historical averages. And as I said, in all the segment, there is a pricing cut which is happening. As per our channel checks, in used vehicle, pricing has already come down to 67%. And in new vehicle as well, as I said, if the GST rate cut which has happened, let's say on the lower segment vehicle from 28 to 18%, in the higher segment vehicle from 53% to 40%. So approximately there is going to be a value decline of roughly 10%, right? 10 to 15%. So unless we say that, value growth, while there is going to be buoyancy in the volume growth, but unless we make a case that, volume growth is going to, increase in volume growth is going to compensate for this loss in the value growth, your total industry growth is going to remain muted. So as per our analysis, from financing perspective, since it happens on all-inclusive pricing, disbursement growth is going to remain muted, in FY26, which is going to have negative impact on the loan growth. And in some of the names that is not priced in actually, especially for the auto financiers.
Which ones is it not priced in?
Not priced in.
Can you tell us the names?
Yeah, so like for example, we have been negative on Cholamandalam. The valuation is, way too higher. Historically, let's say when they were growing between 2010 to 2020, Chola used to grow at 20% CAGR. At that time, the valuation used to be lower. Now, in FY26, our assessment is loan growth is going to come down to roughly 20% versus, let's say, 35 to 40% that they have done in last 2 years. And 60% of Chola's book is roughly, auto loans, where we do see, disbursement issues cropping up. So, so Chola is going to be one place where we are negative. For the other auto financiers as well, like for example, Shriram and MFS, disbursements are going to be, to get the disbursement, it's going to be challenging. But having said that, there the valuation is, not that, steep as compared to Chola. So that is why in the vehicle financer our, pecking order is, Shriram followed by, let's say, MFS and then Chola.
Any other stocks in your coverage where valuations are high?
Yeah, so for mostly, we prefer banks over NBFCs and large caps over mid caps. And one of the key theme here is we actually have a preference towards names where valuation is benign and at the same time there is no asset quality risk. And in that backdrop, all the mid cap names, whether it is on the banking side or whether it is on the, let's say, NBFC side, where valuation is just way too high, we are not comfortable with those valuations. So as I said, Chola is one name. Some of the affordable housing names where, valuation is more than, let's say, 2.8 times, 3 times, there we have, some bit of issues because in the adjacent segment to personal loan credit card, like, for example, in low ticket size business loan, LAP loan, micro SME loans, the asset quality issues are cropping up. So in mostly in NBFCs and mid-cap banks, which have higher exposure to this, stress segment and where the valuation is completely high, those are the places we are actually negative.
Got that. So your preference is for large private sector banks?
Yeah. So it's going to be, first of all, it's going to be banks over NBFCs and, large caps over mid caps. So our preference is more for, let's say, ICICI Bank, HDFC, SBI and large banks. In mid cap names, as we need to be highly selective, and that is why in mid banks we like City Union Bank. In NBFCs, our preference is more for the large names, Bajaj Finance we like, AB Capital we like. And in the mid caps, again, we have to be very, very highly selective. So like PNB Housing we like, because the valuation is hardly, let's say, 0.9 to 1 time with no asset quality risk. Then in affordable housing name, we like Aadhar and Awas.
Very quickly, before we let you go, Ajit, any view on Bajaj Housing? A year or so ago, the stock went dancing away more than 40% post-listing in a matter of a few days. From there, it's come down to, 110, 115 rupees, which is more palatable, given that it had gone to, I think, around 6 to 7 times to price to book. Not cheap, but given the parentage, given the scope of growth, what's your view on the stock?
Yes. So no, obviously, Bajaj parent is of very high quality. There is absolutely no doubt about it. And even the management quality is very high. The only thing that probably, we are facing is mainly because of the repo rate cut, there can be some bit of pressure on the margin side. And when loan growth is going to moderate from here on, and when there is a margin pressure, that puts downward pressure on the ROE. And as you rightly highlighted, valuation is not cheap. It's trading at more than 3 and 4 times. that makes, stock re-rating quite difficult.
Got that. We'll leave it there. Thank you very much for joining us. Really appreciate your time here on CNBC TV18. Well, I think we'll just get to the 9-10 calls now. Sudarshan and Mitesh are back with us. Sudarshan, what do you have?
I have Tata Steel. Consider buying Tata Steel with a stop under 168.
Mitesh, what about you?
Yeah, I'll go with a buy on Naukri or Info Edge. Look at targets around 14, 60, 65.
Just a quick recap of, thanks gentlemen for those trades. Just a recap of some of the stocks which are moving on the back of what we covered since the morning. So festive season boost, auto names, Maruti and Hyundai. Hyundai, of course, is up 4%. Stocks run very well off the lows. And Maruti is picking up pace with about a 2.6% bump. Maybe we'll look at M&M a little later. KEC, RVNL, Brigade, new order wins coming in for these companies. So stocks are up 3% to 1.5%. Birla Corp, JK Lakshmi Cement are other names which are coming up. Stocks with news flow here. Shilpa Medicare is up about 0.8. JBM Auto is another one which is coming up with about a 1% gain. And of course, defense, right? So Zen Tech is up 3. Idea Forge is up 2. You heard from the Defense Secretary earlier. Paras Defense is another name. Yesterday, shipbuilders did very well. Mazgaon, Garden Reach, etc. So we'll have an eye on that as well. But market opens. First rates coming up on your screen. It's positive, 25,240. The Nifty Bank is trying to find its feet, about absolutely flat actually. 55,335 on the Nifty Bank. The mid-cap index is up 0.17. And I think the small-cap index is coming up with a small amount of gain as well. So not very much to really show for one way or the other this morning in terms of market opening. So 25,230, absolutely 30-point kind of flattish start. The Nifty heat map gives you a quick sense of where we are. So Maruti, Eicher, M&M, etc. on one end, Bajaj, it's all auto, Hero. So the top 4 gainers of the Nifty are all auto names. On the other side, you've got Sun, Eternal, Trent, etc., which is coming through. But majority, about 30-32 names are in the green. Right at the word go. Rima.
Well, it's autos all the way where you can feel the festive cheer. And as you pointed out, the Nifty Auto Index is leading from the front, top sectoral gainer, and that's up close to about 1%. IT after yesterday's gash isn't recovering, but at least it's not falling. So it's a flat opening on Nifty IT Index, absolutely unchanged. Talking about the winners, well, the top 4 are auto names, Maruti, Eicher, M&M and Bajaj Auto. Maruti right on top, and it's a fresh high on that. It's crossed the 16,000 mark today, 16,180 on Maruti. For Eicher Motors too, it's a fresh 52-week high, 1.5% up on Eicher Motors. After that, you are seeing a Bajaj Finserv seeing some interest in buying. That's up close to about 0.5%. In IT, Infosys has rebounded. Infosys was down close to about 2.5% yesterday. It's up nearly 0.5%. On the way down, Adani Group stocks are correcting after 2 days of a heady run. Adani Enterprises, Adani Ports under pressure, both down nearly 1%. Softness seen in Sun Pharma. Eternal is a bit subdued. Tata Consumer, Trend. In fact, if you pull up the sectoral movers, it's the FMCG index, which is a bit downbeat, and Realty too, and PSU banks. I think these are some of, sectorally at least, at an index level where you can see some red.
Well, that's right. A few stocks, Rima, from the broader markets that are bucking the trend. You have JBM Auto. They have partnered with a Dubai-based firm to launch e-buses in the UAE market. Could explain one of the reasons why the stock was bursting away. It's up 4.5% as we speak. If I'm not mistaken, though, I think this came in market hours, actually, towards the end of market hours. Stock, though, up close to around 4.5%. So good move is what we're seeing. KEC International, they told us here on CNBC-TV18 just a week ago that they're likely to close out a 3,000 crore order. That's come through. The street loves it. The stock bursting up close to around 7% or thereabouts. So even though the street was anticipating that, clearly giving a big thumbs up on that counter. What else? What's doing well? Om Infra, we don't talk about this stock too often, but that one is moving higher on very large volumes, more than 10% up on this particular name. So I'm not sure what's gone on there. You have all cargo terminals, volumes fairly decent, stock up close to around 7%. So good up move is what we're seeing out there. Zuari Industries, no, not very high volumes, only around 50,000 shares. So that's another stock that's moved higher, just in the first few minutes itself, up and about 7.5% higher. What's not doing well? The pain continues for Dreamfolks. Now it's down to around, 105 rupees thereabouts. 1/5 of what it was at its peak. And you have Hariom Pipes, that's coming for profit taking. Had a big run last few days. Stock down close to around 3% or thereabouts. So good start is what we're seeing. Some green, mid-cap index still trading in the red. Let's see how this goes. But after a couple of days of pause, a little of consolidation, let's see whether or not the bulls can fight back.
You know, Urban Company is also taking a bit of a pause, right? Had a one-way kind of a move. It came off the day's high yesterday. What? Fifth day, right? Fifth or sixth day in the markets? Yeah. So basically, listed at about 162. Yesterday's high was about 201. And finally closed at 186 at 183 right now. Urban Company, large amount of volumes on it right now. NetWeb, we've been highlighting this, right? It's gone up like a rocket. Absolute rocket. It's down about 4%. This year, it's up. This year so far is up 25%. Of course, 2024 was a massive re-rating year. Anand Rathi is down about 1.6. I mean, these are just small pullbacks after very large, impressive runs that most of these stocks have had over the last couple of days. Suddenly, I sense that the momentum, at least in the broader market, is swinging to the positive side. So KEC, I think we highlighted, right? 7% on KEC now. So 928 is the second largest volume-led gainer right now on the NSE. Of course, I mean, all the auto stocks we've been talking about. E2E Networks is up another 5%. That's another one which has been like a rocket move lately. Taj GVK is up about 3.5% or so. MK is coming up with about a 1.5% pop. Sonata Software is up 2%. Sirma is up 2.5%. Thermax is up 2%. Can go on with more, but volume start to thin out. But this is the majority of the volume-led gains that we are spotting for you. Rajiv Batra is head of Asia and co-head of Global Emerging Markets Equity Strategy at JP Morgan. He's joining us now from the sidelines at the 10th annual India conference that JPM is holding right here in Mumbai. Rajiv, it's always a pleasure to have you on CNBC-TV18, and thanks for joining us. Let me ask you to tell us the big questions you are being asked, Rajiv, by clients, investors about India, because we've had a period of relative underperformance. But as James Sullivan and others have been pointing out, the last 1 year has been followed by a couple of years of sharp outperformance. So is it just that, or it's a mix of things? What's top of mind, Rajiv?
Good morning, Prashant, Rima and Nigel. And first of all, happy Navratri to you and your viewers. Overall, a good start of the festive season with all hopes and prayers from my side too. The questions which commonly being asked, number one, question is when we expect a thaw happening in US and India relationship. That's the number one question to me and my management right across over here. The second one is when we can expect the double-digit growth handle, because now 4 to 5 quarters have gone. India is still trading at close to 5 to 6 peg ratio, and market wants them to come at a 2 peg ratio per se. So the double-digit growth is the second one. And last but not the least, when do we expect foreign investors to come back to India after last 4 years of exodus? Because it's not just a 1 year story. If you look at accumulative flows for the last 4 years, FIs are missing in India. So that's what we are trying to address and trying to show them on ground that what is happening in India and why you should revisit the thesis. And especially where India is seeing the worst ever underperformance since 1990 of close to 25 to 30 odd % in a scenario where EM assets or Asian assets are making a comeback under the big diversification theme because of the dollar weakness, because people want to move away from US denominated asset class. In that scenario, India is still not making a comeback. So this is the kind of a questions we are all trying to address through ourselves and making them meet even experts also on here.
So Rajiv, how are you addressing the question on when FIs will make a comeback into the Indian markets? What is your own sense, speaking to so many experts and investors since yesterday?
So Rima, it's all interlinked. So number one most important perspective if I want to see is how the relationship continue between India and US. Remember, India and US have been doing businesses, investment all across for 25 good years between each other. And US have emerged as one of the biggest partner for India. And we have seen the pleasantries which was being exchanged between President Trump and Prime Minister Modi during his 75th birthday over there. So investors want to see now this to be taken one step further, maybe by reducing tariff by 25%, the additional penalty that was imposed on India 2 months back. So thawing of relationship is the catalyst number one, which can lead the risk premia in India to get lower, and India's P re-rating can happen in line. Again, this is a contrarian view I'm giving you, a P re-rating for India, what other emerging markets have enjoyed year to date or for the last 1 year, and India has not enjoyed at all. That's number one. Number two, the earnings momentum or revival of earnings. Remember, as I've said earlier, 5 quarters have gone. India's trailing 12-month earning growth is in handle of around 4.5, 5, and trading at a PE of around 22. Investor want double-digit handle to come. That justifies India PEG ratio close to near what S&P 500 is trading, 2.1, 2.2x kind of a stuff. And that's where India makes a comeback. And lastly, continuing the good work, which we have seen in form of 3 arrows. Arrow number 1, monetary policy easing. Arrow number 2, in form of tax rate cuts during the budget. And arrow number 3, the GST cut. Now the market want to hear the 4th arrow, that is the next generation reform in form of deregulation and easing my FPI and FDI entry into India markets. So these are the 3 set of measures what markets want to hear.
Okay, all right, Rajiv, good to see you, Ben, and hope you're having a good conference. Let's focus on the third point that you mentioned. GST 2.0, that's clearly got a few sectors very, very excited. Case in point being autos. And you all as well have done a bit of a pivot. Do you think that sector is set for better times? It's already had a bit of a run. I think earlier you all were neutral on that sector. But how do you expect this sector to pan out from here on?
We think it's a start. It will lead to an improvement. It's very easy for people to anticipate when the GST cut is happening. It will be just benefiting staple. In reality, when you start saving more, you will go behind your aspiration and more of your discretionary consumption, which you have been postponing because of lesser amount of a saving you have in the past. Taking that into account, step 1, I never anticipate people will start going straight into the real estate sector, buying houses. But the easier one is more 4-wheelers, more 2-wheelers, and even some jewelry stuff also for their near dear ones overall. So discretionary items are the one who will be the beneficiary. And I don't think it is just a 1 quarter, 2 quarter story, because GST cut is not one-off. It is here to stay. And like we have started with the GST cut, maybe in 12 to 18 months, on the same show, we will start talking about even the 8th pay commission, which also will be a bigger driver for consumption, or you can say further accelerator for consumption after the kind of 3 arrows which we have seen so far.
So better times ahead then for the auto pack?
100%. It's consumption over capex, and that's what we are going to see for the next coming 4 to 5 years in India.
Okay, all right. The uncertainty continues on the tech pack though. A bullish argument would be that they have not done much, they have underperformed. Maybe the bad news is in the price. When you get sound bites coming in from the United States like we saw over the weekend, maybe it's not a very material impact. Most sell-side notes had written that. However, the index itself was down 3% yesterday, telling you the kind of nervousness on this sector. Do you think there's still more pain, no big growth, headwinds coming in from the United States, and deal closures taking longer than anticipated as well? So you'd rather stay away?
No, we are more in a transition kind of a phase at this juncture, because market is trying to figure it out where we are heading in this kind of a geopolitical uncertainty, what kind of a world we are in, whether it will be a unipolar, whether it will be a bipolar, or whether it will be a multipolar kind of a world over there. And definitely then my exporters are at a stake in this kind of a world which we are going enter into. Taking that into account, it's unfair then to give a lower risk premia to such sort of a places. And the better way to trade this space is through earning growth. Now, growth is a key problem in IT sector from the last 12-month perspective or last 24 and 36-month perspective. They kept on delivering bottom line for you by cutting down people, by firing staff over there, and still delivering growth for you. But right now we are at a cusp where your IT sector growth has come down less than 5% on a 12-month trailing basis. We saw the similar things happening in the FMCG sector also for close to 10 years. And unless the revival applies, people never gave FMCG sector 60, 70p. They were bringing it down to from 60 to 50 to 40 to 35. I believe in IT we are heading in same phase until unless IT gets back 10% plus kind of an earning growth from a future lens perspective.
And that, for now at least, looks a bit unlikely for this year and next. Rajiv, just the bigger picture about emerging markets. Now, you believe it's the coming of Goldilocks market when it comes to Asia ex-Japan. Can you explain your thesis? And it's had such a good run. I mean, this is the best performance we've seen since the dip in April. Is there a risk that the positive catalysts are now, we're running out of positive catalysts?
Not yet. I think this is just a start. Just to share some number with you, a 1% dollar depreciation leads to 4.5% increase in EM equity performance based on the historic sensitivity basis. This year, dollar has gone down 12%. If you take that sensitivity into account, you need to be easily up 50 to 54%. EM is up close to around 28%. Asia is up around 26% only, which means there is still performance based on the historic standard pending. Now, going into the next year, JP Morgan is forecasting end of this year DXY at 95, and by June next year, 92, which means further 5% depreciation. And again, you multiply same sensitivity, another 25% return. If dollar is on the downward slide, diversification is going to remain a criteria. And not only equities, across asset classes in Asia, in emerging market, we are going to see benefit. Look at this year, Asia ex-Japan index is up 26%. Fixed income in Asia has given 7% return. Cash has delivered 3% return. And most of the currencies have driven 5% return. Next year, when we are going to see a synchronized global easing, where my US is increasing its fiscal deficit, Europe is also doing the same, and China, to revive their growth, provide you 40 to 50 basis points of fiscal thrust, along with 80% of global central bank easing. What does it mean? It means we are entering into synchronized easing cycle, which has happened in past during either GFC or during COVID. And after that, we all know what happens to risky asset classes and market. So we are entering that environment over the next 12-month period, which means we are just at the start over here. And if you take my positioning into account, global investors are 800 basis points underweight on emerging market. This year, they have not participated in EM equities fully, and they have missed the rally. Korea, China, Taiwan, all rally has come on the back of domestic money per se, which means my FIIs will be the chaser into this rally as you go into the next year.
So how much more upside for emerging markets? I mean, in percentage terms?
So we are working for our 2026 outlook targets for EM overall. We have just surpassed our bull case on emerging market of 1350. The 12-month forward Asia ex-Japan index target is 1,000 points from year on. And we are saying it will trade at 16.6 PE, which is still below 2007 territory and 2021 territory. But the kind of a liquidity train which is going to hit us, I'll not be surprised the regional indexes going to trade at even at 20 PE also.
Rajiv, on that point about synchronized rate cuts, right? Global synchronized kind of easing. The call is that economies stay strong, but you get rate cuts. So best of both worlds in that sense. That's the call. I mean, you don't see significant weakening because then, in response to that, if you get a cut, that's not exactly great. But you're saying that economies will remain strong to so-so, but you get rate cuts.
Prashant, that's what's been happening since April. In April, US have made 4 pivots for us. Pivot number 1, they talked about fiscal austerity, and they have given us OBBA. They set the low. Second, they set the lower bar for Fed also to cut, and now we have seen Fed has started cutting. We are calling for 75 basis points more rate cut from year till March by the Fed. Third, we all worried about the AI diffusion law, not supplying the high-end tech to the US over there, but they have eased the chip exports and everything to the rest of the world. And last but not the least, we worried too much about the tariff at the start of the year. But what happened finally? Deals are happening, tariffs are much more measured over there, and exports are still growing. So taking that into account, where my economy is still growing higher, and consensus economists are literally eating back their word and revising growth higher. Remember, consensus was forecasting recession in the second half of this year, And now all the forecasts in the US are for around 2.5 GDP growth in the third quarter, 2% GDP growth in fourth quarter. And mind it, for the next year also, growth number is 1.9, which means they want to run economy hotter going into the next year.
Yeah, no, absolutely. Great conversation, Rajiv. Thank you very much for joining us, and hope you come on more often. Good sort of 360-degree perspective.
Thank you.
With you, as always. Well, I think I want to play out one important soundbite here now. So, India's chief economic advisor, Anand Rathi has said that he expects GDP growth to be near 7% this year after the GST cut. Speaking with CNBC-TV18's Shireen Bhan on the sidelines of Network 18 Reforms Reloaded Summit, he said he expects revenue growth to remain on track and is confident of achieving 4.4% fiscal deficit targets. Listen in.
Fiscal second quarter growth numbers are looking quite promising based on the high frequency indicators we track. But of course, that is still only about 1.5 to 2 months of data. So we have to wait and see how did September fare, etc. But we're sort of quietly hopeful that the second quarter has maintained the momentum that we saw in the first quarter.
And so closer to the 7% mark is what you're hoping for, on the back of what the information you have.
I'm hoping for, rather than saying I'm predicting it. I'm not predicting it.
Fair point.
I'm simply saying, based on the trends I have seen, it's the number that I hope for. Yeah. We are confident that the final number will be 4.4% of GDP, which is the gross fiscal deficit. We have had good non-tax revenue growth, and overall revenue growth is on track in comparison to last year's numbers. And we feel that the festival season will last all the way until the end of the year because of successive, the Diwali festival spilling over towards Christmas and New Year, etc. So we are confident that the fiscal math will hold up very well for the current financial year.
All right, let's focus on the steel sector. And we have Nomura that's come out with their view on the steel space itself. They're turning bullish on India's steel sector. They're citing a mix of both global as well as domestic factors into play. That includes the production cuts that we've seen in China, potential stimulus, and the improving local prices as well. They're forecasting 25% EBITDA CAGR over the next few years across the steel space. On JSPL as well as on JSW Steel, they have a buy rating. Target prices come up for you on the screen, 1,300 rupees. And 1,150 rupees. For JSW Steel, well, 3 big points stand out. One is the capacity expansion of 7 million tons by FY28, aligning with the cyclical recovery. They're also targeting 50% self-reliance in iron ore through backwardation, which is good. Backward integration always, holds them in good stead. And they're better placed than peers, with domestic iron ore prices expected to stay below import parity. So that's about JSW Steel. Moving to JSPL then, they highlighted the following reasons. A planned 6.3 million ton capacity addition by FY27, which will boost the product share, the flat product share, to around 65%. They're also looking at enhanced raw material integration, and they're expecting cost savings from the new pellet and captive power plant. To sum things up, basically Nomura is seeing better times in the steel sector. Capacity growth, cost control, and supportive macros as well will help them in terms of earnings from here on. So that's what Nomura has to say on the ferrous space. Moving to the cement space, though. We have with us Mr. Neeraj Khoury, the Managing Director at Shree Cement, who joins us on the show. Hi, Mr. Khoury. Good to see you in. Well, before we come to you, we're just going to alert our viewers about the 3 big points we're going to be focusing on in this interaction. The impact of the GST rationalization. Long pending demand from the industry that's come about. The update with regard to progress on capacity addition. And finally, Shree Cement is sitting on a lot of cash. How will they use it? That's going to be the top 3 talking points. Well, Mr. Khoury, pleasure having you on the show as always, sir. Let's get straight to the first point. Well, considering the recent GST rate cut, how does the industry dynamics change? 2 points I want to understand. One is, what is the effective price cut you have already taken? And second, do you maintain that volume growth stance of around 4 to around 5% year on year for FY26?
So, Nigel, good morning, and thank you for having me on the show. First of all, this is a transformational step, something which we were long expecting. And now that it has happened, we are absolutely clear and confident that it is directionally good for our industry, both for demand growth, but also for ease of doing business. For Shree Cement and for the industry, one of the things that we have done, Nigel, is very clear, is to make sure that we pass on the full benefits of the GST to our customers and the consumers. We believe and we are convinced that it is a right step in terms of boosting the overall consumption growth. Demand growth numbers we had taken 5% till now. We believe with this there would be some acceleration of demand, maybe 1 to 2%, and that is something that has yet to play out. But our first level estimates would be that demand growth will go up from 5 to about 6.5%, and that is the good news for all of us.
Okay, so around 6% volume growth is what we could expect from Shree Cement for this year?
Yeah.
Got it. All right. Also, the other question that I had was, since cement is going to get relatively cheaper, people may want to upgrade the kind of cement they're looking at. I think premium sales for you as a percentage of trade sales is roughly around 17%. You could correct me on that number. So do you think that's likely to be the case, where people start using better quality cement, more premium cement, and that would help you in terms of premium as a percentage of your sales mix moving up?
So Nigel, in any market, there will always be a different segment of buyers. Value buyers will remain value buyers, and people who would like to upgrade will like to use this opportunity of reduction of cement prices to upgrade the quality of product that they are buying across segments. We believe that yes, premium cement sales for us would go up. We are at 17% till now, and I think we would see this to go up to about 20% in the near term. This is our first level estimates. I'm sure we should be able to meet this kind of a number, the targets of 18 to 20% now with the reforms in GST.
Got it. So we've got a couple of numbers out. Volume growth of around 6%. Premium as a percentage of sales mix moving to around 18 to 20%. But do you maintain that strategy, value over volume strategy? And are you on course to deliver that EBITDA per ton number of around 1,350 to 1,400 rupees for FY26 on the whole?
So I would not like to focus on EBITDA, what we'll be able to deliver. There's so many factors at play, Nigel. Having said that, we do believe that our strategy of value over volumes has played out well for us, and that is something that we would be very keen to continue in the future as well. This is something that is helping us to improve our brand presence. It's helping us to improve our results. And that's a strategy that we would like to follow in the coming months as well.
But you are able to hold on to what you have been doing. Last quarter was more than 1,350 rupees. So that should be par for the course, right?
Yeah.
Run us through your capacity addition plan, sir. You had that target of around 80 million tons. By the end of this year, what will the capacity be? Next year and post that as well. And have you all visited some units? I believe a couple of units are on the block. And I know some of your peers who have visited South India as well. Were you all part of the visiting committee?
This question keeps coming back to us, and we are very convinced that our focus has been organic strategy, and that will continue to remain our focus. Having said that, if some good opportunity comes, we would be very, very willing to look at it. But when we said our growth plans, it is largely organic. This year, Nigel, we are at about 70 odd million tons is what we should end up by next quarter, yeah. And then we have some more plans to grow our capacities, which we will reveal as time comes in. But so far, we are more than happy to pursue our organic strategy. I think that there is a focus that is there for Shree, and there is a focus that we would like to maintain in the coming years as well.
$1 billion of cash, sir, and the focus is going to be organic growth. Have you decided what you want to do with that cash balance? It's diluting some ratios as well. So the street has been requesting, and we as well on the channel have discussed with you all that maybe there's a plan to utilize some part of that cash. A probable one-time dividend payout could be likely. I don't know whether buyback makes sense as well, going by the change in taxation rules. But should we hear something about it, say at the end of this quarter when you report your numbers?
Nigel, I am very clear. This is a board decision. I will not like to comment on it. But we have solid plans on how to use this cash to grow our capacities in the coming years. I'm sure the board will review both of that together. And to me, there's the cash we should be using and we would like to use to expand our capacities as we go forward.
Just one more question, sir. You know, as part of GST getting rationalized is good news, right? But earlier there was that SGST component as well. And there was some kind of incentives that you should get from the state. One is capex-led and one is by the GST angle. Do you see some kind of risk that since the state will get less money, then in fact it could hit some of your incentives? Or do you think that y'all are reasonably protected on that front and it will not be that big an impact?
It will not be that big an impact, Nigel. There are places where we have fiscal incentives, and most the way forward would be that we would like to sell little more in plants. So I don't see any material impact on the SGST component of the fiscal incentives on our results in the coming years.
Final question then, in UAE, you all had announced an expansion plan out there. Could you tell us how is that progressing? What's the expansion plan? Because some on the street thought that unit was struggling, but then you'll clearly see an opportunity that you're going ahead and increasing capacity there.
So as you know, Nigel, UAE has been doing very well in the recent past. The demand in the country is also, and not only in the country but in the region, is positive, and therefore we decided to pursue an expansion in our UAE plant. The plan is already under execution. The construction has already started, and we expect that by next year end we should be able to commission that new capacity of 3 million tons in the UAE as well.
Mr. Khoury, always a pleasure, sir, having you on the show. You're sounding reasonably optimistic about the prospects ahead. September would be a little bit dullish owing to the monsoon as well as GST 2.0 coming into play. But for the year, 6% volume growth, EBITDA could be maintained in that vicinity of what we have seen in the past, and premium sales could get a bit of a leg up. So thanks a lot for joining in. By the way, before we slip into a short break, take a look at the Nifty. That's moved to the low point of the day. We're moving closer to the lows that we saw yesterday. You don't want this 25,100 mark to get broken on the downside. Remember, today is the weekly expiry as well. So that mark should actually not get violated. Otherwise, you could see further selling pressure. So at a crucial juncture, for the time being, though, we'll slip into a short break. When you come back, we'll have Mr. Pradeep Gupta, the Chairman and Managing Director of Anand Rathi Share and Stockbrokers, who will be talking about their 750 crore rupee IPO. You don't want to miss this.
Welcome back. Anand Rathi's 745 crore IPO opens for subscription today. Pradeep Gupta, Chairman, Managing Director at Anand Rathi, is now here with us in the studio. And today's conversation, we will focus on one, how is Anand Rathi's share navigating all the regulatory risks? Two, what are the growth and expansion plans ahead? And three, will FY26 be better than FY25? And if yes, by how much? Thank you very much for joining in. Now, over FY23 to FY25, you've clocked in a revenue growth of about 34%. But we've seen SEBI clamping down on F&O. There is a possible discontinuation or weekly expiry, which can hurt volume. So in that context, can you do better than your historical growth rates of 34% on the top line?
First of all, good morning, Rima, and to all the viewers of CNBC. Yes, I think so far...
Please.
Okay.
Yeah, go ahead.
So far, business is concerned. I think you have to literally look at it, how the business model is being created. And we are very confident that this kind of a growth is going to be persistent and stay with the company. And that's the reason, we are trying to see a different way or innovative way how it is to be done. Typically, what we are trying to see, as we all know, pure broking is something which is directly correlated, and there are lots of, involvement of market volatility. And the moment market volatile, your broking revenues also start getting volatile. So to aloof yourself from that, you have to create a business model where probably how you can, create a model which can give you a sustainable long-term growth and a predictable growth. And that's where, if you really look at Anand Rathi share in stockbroking, which is coming for public, largely having a two kind of a revenue stream, broking and non-broking. And within non-broking, if you really look at it, distribution is one part and margin trading facility is another part. And these two businesses, which is in non-broking side, is largely annuity-driven businesses. So the moment you start looking at AUM, you start getting certain amount of annuity revenue.
So could you, Mr. Gupta, break that down? How much is broking? How much is...
So in Anand Rathi share and stockbroking, if you really look at it, right now, broking 60%, non-broking 40%. And that's the whole endeavor, is how we can constantly...
And what have been growth rates in both these, broking and non-broking?
So if you really see in broking, about 20 to 25%, and non-broking, about 35 to 40% kind of a growth is there. And the whole endeavor of this company and the people, management, everything is working towards it, that how we bring this ratio to 50-50. The moment we reach 50% kind of a revenue ratio, I think you are going to be less susceptible to the market volatility on this company, and that's what we are trying to
How
achieve.
soon do you think it will take you all?
My own perception in gas is, I think in next 2 to 3 years, we'll be able to achieve.
You said 60-40.
It's 60-40. 2 years back, if you really say, it was 65-35, and we are trying to achieve and gradually working towards.
On the broking side, will revenues, the growth decelerate? Let me put it another way.
No, not really. It is going to be constantly grow at the same pace, point number one. And point number two, if you really again look at our broking model vis-a-vis any other companies, and as you rightly pointed out, the way regulator is looking at derivative businesses, there is another component in broking. Broking, cash market and derivative market. Cash market, pure cash plus cash trading. Derivative market is, commodity, currency, and future and option. Now, over there also, if you really look at Anand Rathi share and stockbroking, it's 50-50. Okay, if you compare with any other broking houses or most of these broking houses, their probably this ratio might be tilted towards...
Cash and derivative is 50-50 within broking.
Cash and derivative is 50-50, and within derivative, commodity, currency, and F&O, all three put together. So our dependency on those future market businesses are very, very less. And this whole structure is being not came by default, it's being by design, by strategy which we have set, because we are always advocating customers who are looking from a long-term investments, who are looking from a staying and creating over a period of time, certain amount of investable surplus and constantly generating certain amount of return. And that's the reason, if you really see this 50-50 is maintained, our focus is to our cash market delivery. And if you really look at our yields, are constant from last almost 4 to 5 years, which is 0.09 paisa, which is 0.009%. I think that's the yield, kind of yield is being static in broking businesses. And as I said, broking is about 60% in overall total revenue business.
All right. Hi, Mr. Gupta, and good to have you on the show. And the last issue that the Anand Rathi came out with, it generated a lot of wealth. So some of your investors will be hoping that you replicate that performance. That said, there are some challenges, right, in the near term at least. So the non-broking component would be the interest on the MTF book as well, which has grown. It was 50 crores a few years ago. Now it is at more than 100 crores or thereabouts. But the regulator is also looking at this part of the business. They want to, make it, more friendlier for users. Do you see that as a bit of a headwind? Because that clearly has been the outperforming part of your business if I look at your revenue construct.
See, fortunately, Nigel, it's a very good question. I think one has to look at it, how you are playing your cards in terms of providing funding side. And if you really look at it, margin trading funding is well regulated. Every day, all the positions are being controlled and are available at stock collection level also. So if you really look at our margin trading funding, this is largely given to those customers who are looking to increase their ROI.
Okay.
Right. So that means, what that means is our internal controls and systems are that we are not allowing over leveraging any kind of a customer. So there are checks and balances being created. If you really glance through our book, almost 75% book is below 1 crore customers, right? And there are hardly or very few customers who are getting above 1 crore kind of a funding.
Yeah.
And what we are trying to see, whosoever wants to leverage their position in a systematic manner, trying to generate and increase their ROI, are being given this cutting group. The second instance, I think if from a regulator perspective, about 1,900 stocks are available for our margin trading funding book. Out of that, what we have done, internal systems, internal control says not 1,900, but only 900 scripts are going to be available with a different kind of a margining system. Right. And if you really glance through our book, about 75% book stays in Nifty 500 stock. So it's well spread, well controlled, and we see that there is no...
So short point, you believe the MTF book, will continue, the interest on that will continue to generate a good amount of revenue for you, given the checks, the balances, everything that you've done. Got it. All right. Now, what about, I've looked at the NSE data in terms of market share. You're still relatively small, if you compare it with the bigger names. Do you have a target out here, that you want to go up? Because obviously you're growing the business, a lot of focus out there. And now you'll have shareholders that will keep asking you this question. So is there a target out there?
I mean, it's again good question. I think we as a strategy have not taken that route that we have to constantly look at market share and constantly look at the turnovers.
Yeah.
There are two kind of different businesses. Companies who are literally looking at turnover side and constantly trying to expand their market share in turnover. We are not going towards that. What we are trying to focus is on an individual investor whose investable surplus can be addressed through us, and we constantly trying to increase with that same investors how the AUM of that particular investor can grow along with us, so that investor can be beneficial, and as well as we also can start getting our revenue stream over a period of time. As a result, if you really see, our 30-year plus kind of investors are almost 85%. Okay. If you really look at stickiness of our customers, 5-year plus is 50% and 3-year plus is about 60%. And similarly, to service these people, our RM fraternity, managerial plus kind of a people with us, again, fortunately, it's the same ratio, but 5-year plus is about 50%, 3-year plus about 60%. So that's how the whole component is being created, whole service standard is being created to service those customers.
Mr. Gupta, just one last point on MTF. What is the available amount that you can fund?
So from a regulator side, you can fund, 50% of your net worth and 5% of total overall net worth, you can go and probably provide it. Right. But for that, you need liquidity.
Right. No, but from an individual perspective, if I want to take a position worth 100 rupees, how much will...
Based on the margin. Typically, 30% to 35% kind of a margining is there. So if you are providing security or a margin of about 30-35%, you can go to any extent. So it all depends on what kind of a ratio you are following, what kind of a rules and regulations.
For every stock, it is different as well. I think for NBFCs, there is a limit prescribed by the RBI, right? That's 50%.
So NBFC is completely different. They are not on MTF side. Correct. They are on a LS side.
Correct.
So they are providing LS, and over there, they have a 50% kind of a margin.
Mr. Gupta, we wish you all the best of luck. Thank you very much for joining us.
Thank you.
Really appreciate it, and good luck. So there is Anand Rathi with the IPO on the broking side. But it's not just broking, as Mr. Gupta told us. It's broking, non-broking, which is, of course, distribution, and the MTF book as well. More annuity, more stable, and it's about 40%, and in the next couple of years, perhaps goes up to about 50% each. Well, I think, well, that's goodbye, Mr. Gupta. No problem. All right. Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good to have you with us here. Good morning. How would you look at things? Markets kind of come off a little bit, down 60-odd points. Your trades, Nifty and stocks?
Yeah, sure. So good morning. So from the level of 25,448, we have seen a healthy correction. It can be said running correction in the overall bullish trend. So the 1,000-point rally which we saw from the level of 24,400 to 25,400. So it is retracing that, and right now the 38.2% retracement of this entire 1,000-point rally is placed around 25,050. So this is the immediate support we see in the Nifty that should act as a strong support. So primary trend is bullish. 20 days EMA is also placed around 25,040 odd level. So there are two important supports which are coinciding around the same level. So we can say that there is a strong support between 25,000 to 25,050, which should act as a strong support. So it is a running correction in overall bullish trend. Still Nifty is holding above the key moving averages. So we have a hope that it will resume the uptrend. And some sectors are still performing well, like auto and metal. So overall broader markets are not that much weak. Some sectors are still participating. That's why it seems like a more of a profit booking and not a reversal. So dip should be bought into. That's what we are advising to our clients. And 25,000 to 25,050 should be the strong support. As far as support, the stocks are concerned, yes, there are both way opportunity, like pharma sector has been underperforming for last two trading sessions. So Cipla can be shorted because the technical setup is looking weak. So Cipla September future, I would suggest to go short around 1533. I would suggest a stop loss at 1555. And on the downside, we can expect a target at 1495. The second pick I would choose on the long side from the auto sector only, that is Samvardhana Motherson. So Samvardhana Motherson is placed around 111. So one can go along around this level. I would recommend a trading stop loss at 108. On the upside, I'm expecting a target of 116. 116.
Thank you for joining in. The mid-cap index is down close to about 0.5%. The Nifty hovering around yesterday's low. But Vinay's view is accumulate at the corrections and support seen at 25,000, 25,050. But let's talk about autos. That's the only leg in the market that's holding up in the green. Sudarshan joins in with the latest numbers on Maruti, Hyundai and Tata Motors.
So in a day where most of the stocks are under pressure, one sector that is holding the ground is the auto sector, and it's on the back of the commentary that companies have been giving on the first day response that these companies have received on the first day of Navratri. So first starting with Maruti, it's saying that inquiries that company has received, it has not seen in the last 35 years, and also that there is a possibility that it might run out of inventory for some of the variants. On the first day of Navratri, it has received inquiries for almost 80,000 and it has delivered more than 25,000 cars, and it expects that very soon it's going to deliver almost 30,000 cars. Since 18th of September, the day company had announced GST pass on and also additional discounts, from that day it has been receiving inquiries of almost 75,000 and has been making bookings of almost 15,000. That's 50% higher than that company has been seeing on a regular basis. The biggest positive is the response that company has got for the entry-level segment, where it's saying that response has been 50% higher than the normal days. Second is Hyundai. It's saying that it has delivered more than 11,000 cars, and now it's saying that there is an expectation that this kind of momentum might sustain. And just a few minutes ago, we have received the update from Tata Motors, where it's saying that on the first day of Navratri, it has delivered more than 10,000. So, but do factor in that August, for better part of the month of September, it was a Shraddh period. So there was not much sales that we had seen. So it can be taken positively as well.
Indeed, there were no sales up until now, and people were also waiting for the price cuts to come into effect apart from Shraddh. Thank you very much, Sudarshan, for putting it into context. Get into a break. On the other side, we'll talk commodities. Manisha Gupta will join in. Stay tuned. Welcome back. As promised, let's turn our attention to the commodity markets. Manisha's at the big wall. Manisha, what are you looking at today?
Well, gold and silver, I'm not taking my eyes off that because it's another all-time high in the Indian markets. When you look at gold and silver, it has been one long string and unbeatable, unstoppable. I can look at a lot of those synonyms there for the month of September, but that's exactly how gold and silver really seem to be behaving. So you have gold prices trading at $37.50 an ounce, which is an all-time high, and we did see prices move ahead of that as well. For the silver prices also, it has been one-way rally for the last 3 months or so. It has outperformed gold also. Silver is trading at a fresh 14-year highs in the international markets. We've seen $44 an ounce onto that one, while the Indian markets have crossed about 1,32,000 rupees per kg there. Well, it has to do with the rate cuts from the US Fed and Bank of Canada that we saw in the previous week. And of course, an anticipation that you're looking at more rate cuts for the month of October and then December, and then one more rate cut in the first quarter of 2026. That's exactly what the markets seem to be factoring in at this point in time. And then you have geopolitical tensions which continue to brew in. There are headlines coming in from that. The ETF buying has been stronger in the global markets and the Indian space as well. The central bank buying for a fourth straight year in 2025 also promises to be around that 800 to 1,000 tons of a net inflows. And all of those factors clearly have been very, very supportive there. If you look at the gold now, it also is taken over euro and is the second largest component when it comes to various forex reserves that we've seen in 2025 till time there. I also want to take you through on what we've seen in sense of gold trajectory for 2025. So that is what Jan looked like at $2,650 an ounce. And then look at the month of March, $3,050. So we saw that $400 of a jump up come in 4 months there. $3,500 an ounce was an all-time high that we saw in the month of April. It held on to that range between 33 to 35 until the month of August. And then September has seen an all-time high of $3,750. Look at silver. Even as gold saw some consolidation there, silver did not see that. We started the year with $29.50 and then $33, $39, and we're standing at $44 an ounce at this point in time. So it has been a 50% of a jump up that we have seen in case of silver prices in this year until now. What is the scenario going forward? And that's exactly what we're looking at right now. Citi talks about 3,800. We're trading at 3,750 right now. Commerce Bank has talked about 3,600 of an average. So we still have higher sides to go there. $4,000 an ounce is what Bank of America and Deutsche Bank are talking about. And this could be this year or the next as well. So the timelines really seem to be fading here. And Goldman Sachs has talked about 5,000, but that comes in with ifs and buts. And if this happens, is the best case scenario that they see in case of gold going higher. This is what we're looking at silver then, and we're trading at 44 right now. 43 of an average is what Citi has talked about, and 45 is what Saxo Bank, Metal Focus has talked about. It also has been higher levels that we've seen come in for the market, and then there is a big divergence as well, because when you look at HSBC, they've talked about 34. We're trading at 44 right now, and then you also have First Majestic. Well, the timeline from First Majestic hasn't come, but $100 an ounce again is a level that First Majestic has been talking about since 2016, and then Deutsche Bank is talking about 45. So, well, yes, when it comes to silver, 44, 45 seems to be an understanding there. And then, of course, you have a large divergence coming in from some of those brokerages too.
Wow, on fire. You know, prices are already ripping and we've not seen this kind of a gain in a long time. Thank you, Manisha, for that. Get into a break. On the other side is a special segment. It's The Economy. Lata speaks to economists Jahangir Aziz and Luis Organis of JP Morgan on the global Asian economies, currencies, commodities on the sidelines of the 10th JP Morgan Annual India Conference.